Welcome to another episode of the Michael Yardney podcast, where we try and steer your path towards real estate and financial success. Today I'm going to share with you 5 ways I'm going to ensure that my property investments are going to outperform in this new property cycle. Now, regular listeners would know I usually have guests on my show, but every now and then, like today, I like to have a chat, just me and you, and that's what this show's about. You see, as we work through the second half of this year and the recovery phase of the property cycle, it's typical to take a moment to reflect on the roller coaster ride of the last couple of years. A lot of people are digging deep into the treasure trove of lessons that they've mined along the way. However, in this episode, I'm going to take a slightly different route. Rather than taking a nostalgic trip, instead I want to focus on the bedrock principles that have helped me consistently grow my wealth over the last 5 decades. I'm going to be discussing strategies that have always worked, standing the test of time, outperforming fleeting trends. So this episode may not feed the buzzword frenzy of short-term investment trends or satiate your hunger for the top 10 or top 5 lists that the media is rife with. Instead, we're going to take a deep dive into what I think a more profound reservoir of knowledge, one that prioritizes sustainability over sensation, longevity over limelight. So let's get started.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
As we enter the beginning of a new property cycle, as we work our way through the second half of this year, many of us are going to be looking back at the times we experienced over the last few years and trying to extract some lessons that we've learned to see how to handle our property markets. But rather than do that today with you, I'd like to remind you of some of the foundational principles that I've used to grow my wealth over the last 5 decades. I want to look at some of the things that have always worked rather than things that are working now. Now, to be clear, this is very different from most of what you're going to hear in the news, which basically focuses on short-term investment trends. You know, those headlines that say things that the top 10 areas to invest in 2023 or next year, the top 5 lessons from 2022, or what's ahead for interest rates or what's ahead for the next hotspot. I mean, if you think about it, remember all those short-term forecasts for property. Just look at what happened to all those forecasts made a year ago and the about-face that many of the economists have had to make even over the last couple of months when their predictions were so wrong. It's much the same with the forecast made in 2020 when COVID hit, or the forecast made at the beginning of 2019 when there was the spectre of a Labor election win. They were going to change property taxes then. Again, all those forecasts were wrong. What about all those cliffs? Remember, we were going to fall off those cliffs. I've forgotten them all now. The unemployment cliff, there was an interest rate cliff. There's now a different fixed interest rate cliff. What came of all of them? Now, of course, it's not just the property forecasts. Just look at the financial section of the newspaper or the websites, and you're going to read about all the talk about the Australian stock market. There's a resurgence of Bitcoin. What's going to happen to the stock market this week, this month? Only a few months ago, gold was the flavour of the day. Who could forget the surge in value of technology shares during the height of the lockdown? These type of headlines lead to a short-term focus and encourages investors, okay, let's call them speculators, to try and time the market or look for the next big trend. But successful investing, like many things in life, is counterintuitive and countercultural. One of the core tenets of my approach to investment success is goal-focused and being planning-driven. And the good news is, focusing on the long term, on the big picture trends, removes the burden of correctly trying to guess the future short-term trends, such as what's going to happen to interest rates, what's going to happen to inflation, what the next hotspot's going to be, and stops us worrying about all the many other variables that the average analysts and many investors spend their days obsessing over. In a culture that tends to be market-focused and performance-driven, My approach is seeing our clients at Metropole and also my personal investing act on a financial plan, on a customised strategic property plan. That's what we build for all of our clients, rather than reacting to the vagaries of the investment markets. I've found that being long-term focused means we invest in the type of property asset that has always worked, as I said a minute ago, rather than what's working now or what's going to be hot in the coming year. At Metropole, our approach is to build on a number of frameworks that have stood the test of time, that have been proven, that have been trusted. So let me just go through a couple of the underlying principles that go through my mind, and I believe should go through your mind if you want to future-proof your investments moving forward. The first one is you've got to have faith in the future. While it's easier and more trendy to be pessimistic, I believe that optimism is the only realism. There are so many doomsayers out there. Now, I know I'm trolled by a number of them, particularly on YouTube, and boy, have they been wrong over and over again. There's never been as much information about how to become financially fluent in the public arena as there is today. However, there's just as much financial misinformation, and I guess this has made many people pessimistic. Oh, by the way, I don't know a rich pessimist. Yet based on history, I confidently believe in the ability of our capitalist society to prosper on the back of our collective ingenuity. We live in a capitalistic country, just that's the way it is. So you've got to employ your capital properly. You've got to build your capital. That's the country we're in. And if the last few years didn't teach you anything, they should have taught you that the residential real estate market is an asset class that's too big to fail. Look, neither the government, the Reserve Bank, or even the private banks are going to allow it to fail. Remember how they protected us over COVID, and now when there's issues about people wondering about a fiscal cliff, an interest rate cliff, a fixed interest rate cliff, the banks don't want to be mortgagees in possession. Remember, our residential real estate market is worth over $9.8 trillion. And if you think about it, there's only about 23% loan-to-value ratio, 22%. There's about $2.2 trillion worth of debt. It's a very, very big market. So residential real estate's a great asset class to use to build your wealth because it's underpinned by a large portion of owner-occupiers, homeowners who'd rather eat Maggi noodles than give up their homes. I guess it's the only very large investment class not dominated by investors. And that's one of the things that give it stability. Remember, 50% of the homeowners don't even have a mortgage against their home. They've paid it off a long time ago, and a large percentage of other homeowners have paid off a significant portion of their mortgage. So one of the fundamentals I'm suggesting for you to think about, that I think about the ways I'm going to secure my future, is by having faith in the future and our system of capitalism. The second one is patience. Contrary to the financially illiterate, the strategic investor refuses to act inappropriately to disappointing events. And that's why they've got a plan to follow, and they act on this plan rather than the short-term ups and downs of the investment markets. They recognise that wealth is the transfer of money from the impatient to the patient. So I'm patient, successful investors are patient, but a lot of young people are in just too much of a hurry. They haven't understood the concept of delayed gratification. So I guess the point I'm making is by having a plan, it tells you what to do, but just as importantly, it tells you what not to do. And the plan's got to be realistic. And successful property investing really takes a number of decades to build a big enough asset base. So, as Warren Buffett said, as I said just a moment ago, wealth is the transfer of money from the impatient to the patient. The next way I'm going to make sure that my property portfolio outperforms the averages and works well in the future is to have discipline, and I suggest you do the same. Similar to the principle of patience, discipline sees strategic investors continue to do the right things, even if the fruits of their decisions can't be seen in the short term. Those who held on through 2022 when the market dropped, and we know that a number of property investors got out, they're sitting pretty, aren't they? Just like those who didn't sell up during the difficult times of COVID or the other downturns as well. They're disciplined, and you can be disciplined if you have a plan. If you don't, if you just knee-jerk reaction to the media and the news, then there's no discipline, is there? If you think about it, you shouldn't really be making 30-year investment decisions on the last 30 minutes of news. The fourth way and I believe you should help your property portfolio be future-proofed moving forward is build a great team around you. Even though I know a lot about property, I have a great team around me because property investment's a process, not an event. In fact, the property is a long-term process, property investment. It takes even up to 30 years to develop strong, good financial independence through residential real estate. You may say, Michael, I don't have that long to wait. Well, I don't know what your plans are. I don't know what your risk profile is. So when we put a plan together, all that's taken into account. But you can't become rich in real estate. You can't become financially independent in real estate in 10 years. Now, I know there are websites out there. There are emails I get in my inbox saying you can buy 10 properties in 10 years or 7 properties in 7 minutes. And there's this young guy at the age of 29 who's living off his property portfolio. Now, I also know that if one person can do it, others can do it, but you don't really know the full story behind that. So I do know, though, that successful investors continuously educate themselves so they become financially literate. They know whose advice to take and whose not to. That's because they've learned that most educators and most so-called advisors have actually got a vested interest. They also surround themselves with professionals and mentors who they're prepared to pay for their advice to ensure they maximize their investment returns. By having elastic advice in areas of not only property but finance, tax, structuring, legal matters and estate planning. While successful investors pay for their mentors, I found the average investor gets their advice for free over the internet, in blogs or on YouTube. They haven't learned the simple fact that the cheapest advice is the one that gives you the best investment results. And obviously, you're not going to get that for free. I guess the most expensive advice you get is free advice. That's wrong. On the other hand, financially literate investors accept the guidance of their holistic wealth advisors. And if they've got sufficient discipline and allow time and compounding and leverage to work its magic, their investment success is, well, I'm scared to say it, but almost guaranteed. Now, while it's simple, it's not easy. And here's the fifth way I'm going to ensure my property investment is successful in this new cycle. And that's because I don't make forecasts. I have expectations. Now, the media asks me that all the time. In fact, 10 minutes before I sat down to record this podcast, this chat with you, I was asked by one of the big newsletters, the Financial Review, actually, a journalist from the Financial Review. Hey, where are the best places to invest in Sydney for the rest of this year? Well, I'm not sure that the journalist actually liked my answer because that's short-term investing, isn't it? But I'm continuously asked by various media sources, especially since we're at the beginning of the cycle, and I think I'm disappointing them with my answers because I tend to say something like, well, I know a lot's going to happen over the next decade, but I don't make forecasts. I tell them instead I have expectations. Now, there's a big difference between forecasts and expectations. You see, I expect there's going to be another recession in the next decade, but I don't know when it's going to come. I expect the property market's going to boom over the next couple of years and then prices will slump again. But I don't know when. I expect that some investments I'm going to make are going to do much better than others, but I don't know which ones they're going to be. I expect interest rates are going to rise, they're going to fall, they're going to rise again, probably not for a number of years. I don't know when. And I expect there's going to be another world financial crisis. But I've got no idea when that'll come. Now, these are not contradictions. They're not a form of cop-out. As I said, in my mind, there's a big, big difference between expectations and a forecast. An expectation is an anticipation of how things are likely to play out in the future based on my perspective of how things worked in the past. Now, a forecast is different because it puts a time frame to that expectation. Now, of course, in an ideal world, we'd love to be able to forecast what's ahead for our property markets with a level of accuracy. But we can't. There's just too many moving parts. Sure, there are all those statistics that are easy to quantify, but what's really hard to identify is exactly when and how millions of strangers are going to act in response to the prevailing economic and political environment. Now, if you think about it, that's exactly what happened over the last year when interest rates went up, and all the economists and all the spreadsheets were wrong because they didn't understand how the people on the ground look at property and look at their home. Now, of course, there's also going to be X factors that crop up every year. In other words, things that are out of the blue, like COVID that came. There's going to be good X factors. There's going to be unusual ones. I mean, who would have a couple of years ago thought that we'd have 12 interest rate rises over a 12-month period? Who would have thought we'd have a global pandemic that would shut down our cities? Every year there are difficulties locally and overseas. Who would have thought we'd have a war that would go so long in Russia and Ukraine? Some of these X factors are on the positive side and some are on the negative side. So what I've found is the most practical approach is to have expectations of what could happen without specific forecasts. That's because when you expect something to happen at some stage in the future, you're not surprised when it happens. Expecting the worst while preparing for the best forces you to invest with room for error, and the psychological effect of it is it prepares you for the inevitable disappointments. Now, this is exactly how I planned for the property downturn of 2018, 2019, and while I was prepared for the challenges of 2022, I went into those times with a substantial financial buffer to see me through the ups and downs of the market. To be honest, I thought I was going to end up using that during COVID, but in fact, my property portfolio and my business did very well. See, I don't know when property downturns are going to come, how long they're going to last, how that's going to affect the value of my property portfolio or the cash flow of my business. But I knew a downturn would come again once. I was prepared for it with cash flow buffers that would see me through difficult times. It's a lesson I learned during the recession of the 1990s when I was much younger, much more naive, had very high borrowings, and went through difficult and challenging times. I didn't go broke, but a couple of my good friends did go broke during those times. A lot of developers did. Just made me a much more cautious investor. What I'm trying to explain is there's a huge difference between I expect the next property downturn sometime in the next decade, and I expect the next property downturn is going to be, I don't know, in the second half of 2027. So all this means is it's one of the big differences in how I invest. If I expect the property upturn we're currently experiencing will be followed by another property downturn, then I won't be surprised when it comes. But since I don't know when it'll happen, I won't make that the focus of my property investing, trying to time the property cycle. That's because trying to time the property cycle or looking for the next hotspot are two of the reasons many property investors fail. On the other hand, strategic investors maximize their profit during the property booms, and they minimize their downside during the bust by investing in assets that, as I've said a few times, always work, rather than looking for the next hotspot or the type of property strategy that works now. Though investment-grade assets in investment-grade inner and middle ring suburbs of Australia's big capital cities, the type of property that's going to keep growing in value over time without fluctuating wildly in price when the property cycle slows down. Now, as I said a moment ago, there's always going to be an X factor. There's always going to be unexpected risks you don't see coming. So strategic investors try and protect themselves, as I said, by owning assets, the best assets they can, by having financial buffers in place to ride the ups and downs, by having the right ownership structures, by insuring themselves. By the way, do you have life insurance? Do you have income protection insurance? When I speak to clients and I ask, what's your biggest asset? Oh, they'll say, my property in Smith Street or something like that. And I say, no, it's not. Your biggest asset is you and your income earning capacity for the next 20, 30 years. Have you insured that? So smart investors insure themselves, protect themselves, and they get holistic advice from their consultants. You see, the biggest risk is that one that no one sees coming, because if no one sees it coming, no one's prepared for it. And if no one's prepared for it, its damage will be amplified when it arrives. So that X factor, that unexpected event, seems to come every year, and a major one that breaks the world, tends to come every decade. So in my mind, now's a great time to take advantage and set yourself up for the opportunities that are going to present themselves in property for the rest of this year and into early next year. Now, if you're wondering how to take advantage of this new property cycle, you can trust my team at Metropole to provide you with direction, with guidance, with results. So whether you're a beginner or a seasoned property investor, we'd love to help you formulate an investment strategy. See, we're much more than an ordinary buyer's agency. We'd love to help you. We don't have any properties for sale, so we'd love to help you buy the right property. But as I said a moment ago, property investment is a process. So first of all, it starts with putting a plan together, getting a finance plan, getting all those things, all those ducks in a row so that when we buy the right property, it'll be one that sees you through in the long term. And by the way, if you've already got an existing portfolio, we'd love to help you take advantage of the property market and see, is your portfolio actually going to get you to the next level? Because we're all playing different games. Once you've got a number of properties under your belt, you probably need to play at the next level. That's why we've got a platinum division run by Kate Forbes, my business partner, and Ken Race, who look after our high net worth clients, where we give them the sort of advice you're not going to get on the books, you're not going to get on the internet, because it actually won't suit the majority of people. But interestingly, a recent survey, well, actually, it was an audit of the results of our clients at Metropole, showed that they were 7.3 times more likely than the average investor to own 6 or more properties. So these higher net worth clients need a different level of advice than in the top 1% of investors. Why don't you get the same advice to help you take advantage of this cycle? How long are you prepared to wait? Go to metropole.com.au.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset message, I want to talk to you a bit about something you really have to understand if you want to grow. So let me ask you, are you waiting for things to change? Maybe you're waiting for things to change so you can be happy. Or you're waiting for things to change so you can finally take action, I don't know, on some of your ambitions. Maybe you're wanting your business or your professional practice to step up to the next level, or you're waiting for things to change so you can get involved in investment, or maybe looking after your current investments better. For many people, life's just a bit confusing at the moment, and for many others, they're just too busy. Life's just happening, isn't it? I remember being taught by one of my mentors, Jim Rohn, for things to change, you need to change. Of course, not all change is growth, just like all movement isn't forward. So a change for the sake of change isn't really a good thing, is it? So if you find yourself constantly looking for change, maybe you should try focusing on growth. Try focusing on growth instead. But let me share something with you that I learned as part of my own growth, as part of my own personal development. And that's that all growth happens in stages. It doesn't matter if it's in your personal life or your business or with your investments. And in each stage of growth, people hit a point where they can't grow any further using their existing skills, their existing knowledge. And I see this happening all the time when speaking to property investors. If they want to get to the next level, they're going to need a different set of consultants. They're going to need to do different things. The sort of properties they buy when they first start their investment journey are very different to the ones they buy in the middle of the journey, and very, very different again to when they're at the next stage of their life, when they're maybe looking more for cash flow. So they don't always understand which level of the game they're in. By the way, that's why at Metropole we put a strategic plan together for our clients. It's customized, it's personalized based on where they are, what they need. So again, the point I was making was that at each stage of growth, people hit a point where they can't grow any further using their existing set of skills and knowledge. And that's why over the years, I've always had business coaches, I've always had mentors, I've always had people around me to help me get to the next level. So as you progress in your growth, you gain experience by solving problems, getting things done, transacting. However, sometimes this comes at a price, complexity. Each problem you solve, each transaction you make, each hurdle you overcome adds to this complexity to the point where it holds you back from future growth, from future performance, from future achievement. But you become overwhelmed by all this stuff, by the complications, by the contradictions, from doing things in a certain way for a long time. For some, I've noticed this with a lot of business people, when Mark Creedon and I work together with in Mastermind Business Accelerator, for some people this just becomes a permanent ceiling. Much the same for investors as well. And this is why many people fail to grow beyond a particular stage of their personal development. It's why many investors never get past level 2 or 3 in their investment, and why many business people really only have a job that's dependent on them rather than a true level 3 business. But when you hit that ceiling, there's a smart way to overcome it. It starts with recognizing that working harder and working longer, as you've been doing up to now, it's no longer going to work. You need a new set of concepts and strategies to achieve a new state of simplicity. By developing a simplified way of thinking, communicating, performing, you're going to break through that ceiling. All of this means that you must leave your current state of complexity behind. When you choose your future over your past, then you enter a new stage of growth. So my suggestion is that you think of your development in terms of goals. Each stage of your individual growth comes from having goals, desiring something in your life, something that's new, something that's better, something that's different. Setting higher or more demanding goals, it automatically forces you to keep up, to develop new relationships, to get new structures, new habits. If it's investment, to look at different ways of doing things. You can then use those tools to take you to the next growth stage. New relationships can provide you with larger opportunities and better results. New habits will allow you to reach high levels of performance and achievement that enable you to get there. Learning how to break through these ceilings of complexity is perhaps the most important life skill you can develop. Let me remind you of another famous saying by Jim Rohn. He said, "Never wish life were easier. Wish you were better." Now, while self-education and self-development through blogs, podcasts, books, webinars are a great way to learn, they'll only get you so far. In my mind, the safest and quickest way to get to the next level is to be surrounded by mentors, by coaches, and by a tribe of like-minded people. Now, if you're a business person or a professional, I'd suggest you go to Metropole Mastermind and look at Mark Creedon's Mastermind Business Accelerator, where we help business owners and professionals grow to the next level to grow their business. If you're a property investor and you want the advice that a group of investors who fall into the top 1% who own 6 or more properties, as a large number of our clients do, if you want the same sort of advice they're getting about property, about wealth, about structuring, about tax, why not have a chat with my team at Metropole? Let's see if we can help you change so you can grow. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?